Hi, I'm Kylie Matu, and welcome to Wealthy Millionaire. Today we're going to talk about crypto lending and exactly what it is. But first, I'm not an accountant or a lawyer, and always be sure to consult with a professional before making any financial decisions. Crypto enthusiasts understand that to HODL, which means hold on for dear life, it's an asset that's usually a solid way of making a profit from it. However, you might be tempted to sell if you urgently need capital. But what do you do if your crypto assets are in the red? Rather than taking a loss by selling during a bear market, why not consider crypto lending and borrowing? You can be an investor with crypto deposits, or you can borrow using your assets as collateral. Whatever the case may be, benefiting from crypto lending requires a solid understanding of how it works. So let's explain crypto lending. Crypto lending is similar to the traditional bank loan in that they both require collateral from the borrower in case of default. However, the hassle involved in borrowing from the bank, like credit background checks and verification, is absent in crypto lending. In fact, borrowing crypto is instant. Crypto lending is a process where cryptocurrency investors lend crypto to borrowers in exchange for crypto dividends and interest. The crypto investor, in this case, earns passive income from their assets, while the crypto borrowers use their assets as collateral to get cash or stable coins. What is crypto lending arbitrage? The price of cryptocurrency like Bitcoin, BTC, Ethereum, ETH, or Ripple, XRP, can vary from platform to platform. Crypto lending arbitrage is the process of taking out a crypto loan in one platform and lending it out on another platform. The forces of demand and supply affect the price of crypto prices on different platforms. The higher the demand for the particular asset, the higher the price, and vice versa. For instance, if there's an enormous dump of XRP on Binance, the price will fall drastically, but if there is a low supply of the asset on the platform, it will push the price upwards. This circumstance may not be obtainable in other crypto platforms trading XRP. Therefore, to take advantage of the differences in prices by instantly borrowing, where the interest is low, and lending out in a platform that offers a high rate of interest on the asset, is crypto lending arbitrage. Although the price of cryptocurrency is mostly coordinated in different networks, yet the general trade volume and general activities of buyers and sellers toward a particular asset in a platform play crucial roles in the price of the asset. In addition, crypto lending arbitrage can offer a high return and low risk if you understand the market and can move cryptocurrency from one service to another before the price change. Likewise, to maximize your earning, take into account the difference in the price of cryptocurrency. The rate must be low where you wish to borrow and high where you are lending. So how does crypto lending work? Crypto lending is similar to lending from a bank where you need collateral before you are qualified for a loan. Also, the collateral will be worth more than the amount of the loan that you are taking. Unlike a bank loan, however, you are not using your house or your car as collateral, but your crypto assets. For example, if you own 2 BTCs you are holding to sell when the price rises, you can use it as collateral to borrow some stable coins, like Tether, USDT, to use in the real world. But the moment you pay off your debt with interest, you get your BTCs back. Note that the amount of Tether you will be getting will be worth a lot less than the value of your BTC during the period. This means that your loan to value ratio must correspond. So loan value, or LTV, is the amount of loan dividend by the collateral amount expressed as a percentage. In this case, if the price of your BTC falls significantly less than Tether, the platform may demand that you repay the loan instantly or add to your collateral. What are the benefits of crypto lending? There are 3 parties involved in crypto lending and borrowing. First is a lender. So a crypto lender is also known as an investor. Due to the high volatility of the cryptocurrency market, you can loan out your crypto to avoid the risk of making a loss while waiting for it to bull. A crypto investor earns passive income on their crypto. Furthermore, there is little to no risk in lending out your crypto, as the loan-to-value ratio is usually low. So if the borrower defaults, the collateral can be liquidated by the platform. According to Celsius, you can earn as high as 17% on your crypto investment. Other crypto platforms like uHodler give investors 12% APY on stable coins. Second is a borrower. A borrower of crypto will not be able to trade his assets while using it as collateral. However, his urgent need at the time will be fulfilled. In addition, due to the instant crypto lending process without the need to go through the rigorous process of verification, you can turn to crypto borrowing during an emergency. At the same time, a person can be both a borrower and a lender in different platforms through crypto lending arbitrage. Third, we have lending platforms. Crypto lending platforms vary, and they have diverse policies and agreements for both borrower and lender. Lending platforms can be divided into two. Let's take a look. First, we have centralized lending platforms. These networks work like a traditional bank in some sense. They accept deposits from an investor and lend out to institutions with interest. This way, they act as an intermediary between the investor and the borrower and automate payment on deposit. Some popular centralized platforms include Gemini Trust Company, BlockFi Inc., and Celsius Network. Next, we have decentralized lending platforms. In a traditional bank, a person can secure a loan through the bank and pay the bank back at maturity. In this case, the bank serves as an intermediary who loans out deposits from other customers or sources for money from the central bank and pays the depositor a little bit of money back as interest. However, the introduction of decentralized finance, or DeFi, allows both the lender and the borrower to interact directly on a lending platform without a middleman. Decentralized lending platforms utilize peer-to-peer, so P2P lending, whereby the lender decides the rate, tenure, and in some cases, who they want to lend their crypto. Interest rates on centralized platforms are higher than that of a P2P, and there's also the risk of loan fraud and loan default. However, some decentralized platforms, such as Nexo, insure investments. Just like in a centralized platform, P2P platforms hold collateral in a smart contract according to the terms of the agreement. Now let's take a look at some of the risks that come along with crypto lending. We must take into consideration that we're dealing with new technologies and riskier platforms compared to that of traditional regulated banks. And on top of this, none of these are federally insured, though some efforts have been made with DeFi. Since the funds in a crypto interest account aren't insured like the funds that you have in your bank account, if the exchange fails or goes bankrupt, you could lose everything. In the case of a bankruptcy of an exchange or platform, the assets would become part of the insolvency of the estate and you'd be treated as a creditor of the insolvency. A borrower always runs the risk of their collateral value dropping below the required value in order to always keep lenders whole. At any given point, the borrower needs to monitor their collateral ratio, ensuring that it is staying within a safe range. We must also consider the risk involved with smart contracts, as this new technology uses computer code to govern capital flow within the crypto ecosystem. It's possible for hackers to exploit the system. In times of low liquidity, rates can fluctuate radically if large amounts of capital flow in or out of the system. Though checks and measures are put into place to keep things stable, volatility can still take place. Taxation is another risk when it comes to crypto lending, as many jurisdictions do not have clear guidance of these assets. It becomes difficult for an individual to know the exact tax implications of their crypto lending activities. It's still sound advice to seek out a professional when it comes to taxation and crypto lending. Conclusively, the question is, should you get or give a crypto loan? There are many advantages of a crypto loan to you as both an investor and a borrower. Many platforms will offer instant Bitcoin loans with no verification, allowing borrowers to cater to whatever their needs are without losing their assets. In any case, ensure that you carry out your research and use a trustworthy service. I hope you enjoyed this session on crypto lending. I'm Kylie Mathieu. Thank you for watching Wealthy Millionaire. And remember, the more you save, the more you earn.